Hey everyone, in this video I've got one beaten down dividend stock to buy now and hold forever. Now let's jump right in. Let's see what the dividend stock is and why I like it so much.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So the dividend stock I'm going to talk about in this video for passive income investors is PepsiCo. PepsiCo stock is down 15% off the high. Now, before you start telling me that 15% is not much of a discount, I'd like for you to look at PepsiCo's stock price chart going back 10 years. You've hardly had any opportunities to buy PepsiCo stock at this much of a discount. The current 15% drawdown is one of only 1, 2, 3 that have been worse than that. So there's only been 3 other times when PepsiCo stock has been down more than 15% in the entire decade. So you don't get these kinds of opportunities with Pepsi stock. It's not a stock that jumps down all that often. So when you get these opportunities, it's a time to buy and it's a time to get in and hold it. And you can hold Pepsi stock long term. Now, of course, one of the things passive income investors look for in a dividend stock is the dividend yield, and PepsiCo offers a very respectable 2.97% dividend yield. But more importantly, the dividend payout ratio. The dividend payout ratio measures the percentage of earnings per share that's paid out in dividends. It's a measure of how sustainable dividends are. For instance, in this first example here, you have a dividend per share of $1.75 and earnings per share of $2. That means that's a dividend payout ratio of 88%. That's relatively high. That means if earnings per share were to decline below $1.75, that company would be paying more in dividends than it's bringing in earnings. And just like a household that cannot spend more than it brings in earnings for the long term, in the same way, a business cannot pay dividends more than it brings in earnings per share for the long term. Sure, in the short term, it can borrow money to pay the dividend, but eventually it will exhaust its borrowing capacity. Additionally, it can pay dividends out of its savings, but eventually it will run out of savings. That's why in the long term, if you want sustainable dividends, you want a dividend per share that's below earnings per share at a comfortable level, like the second example here, where you had a dividend per share of $2.75 and earnings per share of $10. That's a dividend payout ratio of 27.5%. For passive income investors, what this means is that the dividend is not only sustainable because even a drop in earnings per share of 50% would still mean that the dividend per share is below the earnings per share. But it also suggests that there is room for this company to increase the dividend payment. So investing in this company brings with it the probability that the dividend per share will rise over the next several years. And finally, the last example where we have dividend per share of $3.50 and earnings per share of $1.45, that's a dividend payout ratio of 241%. The dividend payout is more than 2 times the earnings per share. When you see a situation like this, it's likely that this company is going to pause or reduce its dividend payment. That's very likely to happen in the near term unless the company can expand its earnings per share in a relatively short amount of time. So now that you know more about the dividend payout ratio, you can see PepsiCo has been increasing its earnings per share over the last decade. You can see it grow from a little over $4 per share all the way up to $6 per share, with some fluctuations in between, but longer term that trend is upward. Looking at the dividend per share, you can see a more sustained long-term upward trend from a little more than $2 per share all the way up to $4.83 per share. That means dividend stock investors who bought PepsiCo stock around 2015 are getting more than twice the dividend per share they were getting back then. That's the benefit of getting into these dividend stocks early and holding them long term, especially the dividend stocks that have favorable dividend payout ratios, is that there's a chance and there's a likelihood that they will increase their dividend per share over the next few years, and that will increase your dividend payout. So another reason why I like PepsiCo stock is the company generates solid profitability and cash flow. Its cash flow from operations in the trailing 12 months were 13.25%, and they've been above 12% for the better part of the last decade, going as high as 18% before coming all the way down closer to 12% and then bouncing back to 13.25%. Let's look at what Wall Street thinks PepsiCo's prospects are for the next 2 years. So according to Wall Street estimates, PepsiCo's revenue growth will be 4.5% in 2024 and 4.9% in 2025. That's going to lead to earnings per share growth of 7.9% in 2024 and 2025. So you're going to get 8% earnings per share growth for at least the next 2 years. That's a solid increase in earnings per share, which is more than enough to sustain PepsiCo's dividend per share over time. Already, PepsiCo's dividend per share was significantly below its earnings per share. So if its earnings per share is only going to grow by 8% over the next 2 years, that's going to leave even more room for an increase in dividend per share or a more comfortable dividend per share with a wider margin of safety. Additionally, PepsiCo has done a nice job increasing its revenue. Trailing 12-month revenue totaled $91.62 billion as the company benefited tremendously from the stay-at-home trend during the pandemic. People spending more time at home consumed more of PepsiCo's beverages and snacks. Now, while most people have returned to working in person and going to school in person, there is still a greater percentage of people working from home than there were before the pandemic. And even people that have returned to work in person may work from home 1 or 2 days out of the week. Additionally, schools sometimes have or do offer more online classes, more classes at home. I know the university that I teach at has increased the number of online classes that it offers. And during the semester, I still might have 1 or 2 days where I have students learn from home, where I would lecture online. For example, when I'm sick and I don't want to go to campus and potentially get students sick, but I'm still well enough to teach, I'll hold the lecture online. So that's happening more often now that students have gotten accustomed to Zoom. And so that stay-at-home trend, more people staying at home, working from home, that's good news longer term for PepsiCo. That's a step up in terms of how many times, how many meals people eat from home, how many times people snack at home and drink beverages at home. That's going to increase consumption of PepsiCo's products for the very long term. And finally, this drawdown in PepsiCo's stock price has it trading at a relatively cheap valuation. PepsiCo's stock is trading at a forward price to earnings of 18.9, which is the cheapest this stock has been. Only one time has it been cheaper according to this metric in the last 4 years, and that was during the immediate lockdown of the economy, and that's when the stock price crashed. But it bounced back quickly. So unless you got it like in that 1 day or two, you weren't able to buy PepsiCo stock at a cheaper price than it is now. So for all of these reasons, I think PepsiCo is one beaten down dividend stock that passive income investors can buy now and hold essentially forever. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.